If you have a family member who's disabled, financial and estate planning can be tricky. You don't want to jeopardize his or her eligibility for means-tested government benefits such as Medicaid or Supplemental Security Income (SSI). A Special Needs Trust (S&T) is one option to consider. Another is to open a Section 529A account, also referred to as an ABLE account, because it was created by the Achieving a Better Life Experience (ABLE) Act. ABLE account details. The ABLE Act allows family members and others to make non-deductible cash contributions to a qualified beneficiary's ABLE account, with total annual contributions limited to the federal gift tax annual exclusion amount, $16,000 for 2022. To qualify, a beneficiary must have become blind or disabled before age 26. The account grows tax-free, and earnings may be withdrawn tax-free provided they're used to pay qualified disability expenses. These include healthcare, education, housing, transportation, employment training, assistive technology, personal support services, financial management, and legal expenses. An ABLE account generally won't affect the beneficiary's eligibility for Medicaid and SSI, which limits a recipient's countable assets to just $2,000, with a couple of exceptions. First, distributions from an ABLE account used to pay housing expenses are countable assets. Second, if an ABLE account's balance grows beyond $100,000, the beneficiary's eligibility for SSI is suspended until the balance is brought below the threshold. ABLE account versus S&T. Here's a quick overview of the relative advantages and disadvantages of ABLE accounts and S&T's availability. Anyone can establish an S&T, but ABLE accounts are available only if your home state offers them or contracts with another state to make them available. Also, as previously noted, ABLE account beneficiaries must have become blind or disabled before age 26. There's no age limit for S&Ts. Qualified expenses. ABLE accounts may be used to pay only specified types of expenses. S&Ts may be used for any expenses the government doesn't pay for, including quality of life expenses such as travel, recreation, hobbies, and entertainment. Tax treatment. An ABLE account's earnings and qualified distributions are tax-free. And S&T's earnings are taxable. Contribution limits. Annual contributions to ABLE accounts currently are limited to $16,000, and total contributions are effectively limited to $100,000 to avoid suspension of SSI benefits. There are no limits on contributions to S&Ts, although contributions that exceed $16,000 per year may be subject to gift tax. Investments. Contributions to ABLE accounts are limited to cash, and the beneficiary, or his or her representative, may direct the investment of the account funds twice a year. With an S&T, you can contribute a variety of assets, including cash, stock, or real estate. And the trustee, preferably an experienced professional fiduciary, has complete flexibility to direct the trust's investments. Medicaid reimbursement. If an ABLE account beneficiary dies before the account assets have been depleted, the balance must be used to reimburse the government for any Medicaid benefits the beneficiary received after the account was established. There's also a reimbursement requirement for S&Ts. With either an ABLE account or an S&T, any remaining assets are distributed according to the terms of the account or the S&T. Examine the differences when considering which option is best for your family. Remember the key differences: an ABLE account may offer greater tax advantages, while an S&T may offer greater flexibility. We can help your family decide how to proceed to best provide for your loved one.